This week, the Bureau of Labor Statistics, or BLS, released its monthly consumer price index, which measures inflation levels in the U.S. The index looks at prior month and year to measure the rate of change in the basket of goods and services. The Federal Reserve, as instructed by Congress, has historically aimed for around 2 or 3% year-over-year inflation rates. January's number came in at 6.4%, higher than some analysts expected. For context, December's report printed 6.5%. These reports make headlines and can at times be triggers for short-term stock market volatility. In this week's perspective, we'll dig into buying power. Buying power, sometimes called purchasing power, is a term used to describe the amount of goods and services that can be purchased with a given amount of money. Buying power is affected by the rate of inflation in our economy. A given amount of money will generally buy fewer goods and services in the future than it could have bought in the past. Put another way, buying power decreases over time as inflation causes the value of money to decrease. Let's walk through a bit of history. $100,000 today has roughly the same buying power as about $60,000 did 20 years ago. Another way of saying this, if you needed $60,000 for living expenses in 2003, you would now need about $100,000 to buy the same amount of goods and services. The U.S. Bureau of Labor Statistics provides these calculations to help the public see the trends in the economy. That's inflation broadly. Now let's get more specific. Inflation is inconsistent across regions of the U.S. and is often higher on the Northeast and the West Coast due to higher living costs. Also, inflation is a personal experience. For example, if you own your home outright or have a low fixed interest rate on your mortgage, or perhaps you don't spend much on fuel, your buying power may be less impacted. Retirees and people living off a fixed income may be more concerned with losing purchasing power. Think distribution versus accumulation phase of life. For retirees to maintain purchasing power, their investments and income streams need to earn a rate of return to equal to or greater than the rate of inflation. Now let's talk about preserving buying power. At Vector, we are proponents of math, taking advantage of compounding rates of return. Let's take that same $60,000 back in 2003 and invest it for 20 years. We'll use an annual rate of return of 6% for this example. 20 years later, that initial investment grows to about $190,000 through the power of compounding returns. That is, growth on growth, and what Einstein referred to as the eighth wonder of the world. In this scenario, investing would have outpaced inflation. Now, if instead you had hid that same $60,000 under the mattress for 20 years and didn't put the money to work, your stash would still add up to $60,000, however, much less in terms of today's buying power. Over those 20 years, the cost of living has gotten more expensive, such that $60,000 then would be worth about $36,000 now in buying power. Not ideal. We might as well be storing melting ice cubes under our mattress. The way we experience inflation and investing can be uneven and clustered. We believe the principles of managing wealth around inflation remain steady. Own a diverse portfolio of investments spread across time and asset types. Preserving buying power over the long term is important and is one of the reasons we plan and invest using a bucket-based approach. Short-term money is set aside in stable investments, knowing that inflation may win the short-term round. The remaining segments of the portfolio, however, can then be placed in mid to long-term investments, which have historically outpaced inflation and then some. If you like these weekly perspectives or have suggestions for future episodes, please let us know. Thank you for watching.